How are we poised as we look at the second half of the year? Vikas Khemani of Carnelian Advisors is with us now. Vikas, thank you so much for being with us. So that's really the question, right? And I think the market is very fairly divided between the bull and the bear camp. The bears say valuations are high, earnings will be pedestrian, 10, 11%. The bulls say at least we'll get 12% growth, a revival in earnings, and a consumption boost, an RBI boost. So the market's looking good. What do you think?
I think if you can make out from our past conversations, I'm definitely in the second camp where I
Yeah.
think definitely earnings is on a very big revival. Post RBI action of aggressive interest rate cut and infusion of liquidity in the system, there's no doubt in my mind that corporate earnings would be better. Of course, there could be one quarter and there that nobody can time out. One important factor to watch out is, of course, the BTA with US, which is expected to happen on 9th July, and I think everything goes fine. Then I guess there are not much risk. So generally speaking, I'm quite optimist, and I don't believe that India is very expensive. In fact, I feel that India will get further re-rated, in times to come. I mean, there's no market around the globe of the kind of size, growth, sustainable growth, quality of the growth. So everything is, I think, in place. In fact, most global investors are underweight on India. Indian investors are underweight on equities. So I think, in my opinion, those who are calling markets expensive will keep probably either missing out or keep sort of there could be tactical correction here and there, but I mean, I'm sure those calling market expensive are not expecting it to come to 15, 16 times price to earning ratio. So if it is a little bit of 5, 10% correction here, that is par for the course. That happens all the time in the market. I'm not talking about that. But other than that, structurally, I don't think India is going to get derated further. In fact, I make a very big case for India getting re-rated further in next 3 to 5 years.
You said Indian investors are underweight India?
Yes, of course, because Indian household exposure to equities is still around
Okay, that way.
5%. If you look at, China is 15, US is, 30, 35%. So it is a very small kind of, I mean, 10 years ago, Indians were only 1%. So it's only going to grow from here. I mean, obviously, from 1 to 5 also looks a lot because we are not used to getting this kind of flows. And hence, that's the reason I think there's a lot of narrative which gets created that Indian SIP will stop, Indian flows will stop. But I don't think that's happening any time in a hurry. In fact, that's only going to get more. And once you have that perspective, I think in equities are only going to get bigger and better in everybody's portfolio.
Well, indeed, that's a structural tailwind and a long-term one at that. Because you're the master of finding, individual stock ideas. Tell us a little bit more, in terms of interesting ideas or trends that you've spotted, which could be big plays.
When kind of find spot trends are kind of pretty similar. You don't really find trends every now and then. We've spoken about CDMO, CRO being a big space, manufacturing in general being a very big space over the next 10 years, rising per capita income leading to the, premium consumption is again a very, very big space, which one can look at, and again, I'm not talking about all ideas in general, but you will have to identify specific ideas in those sectors. BFSI itself is a very big opportunity. According to me, if you ask me, the sheer quantum of the wealth, the absolute amount of wealth which will be created it will be in the banking BFSI sector, and more services sectors are coming into the space. So I see a situation where across the board, India will sort of do very well, specifically in BFSI, consumption, manufacturing. These kind of some place would be probably a little bit more niche.
Absolutely. Take your point. We have discussed, of course, agrochemical stocks also. It's something that you like. You're expecting, turnaround to play out. You won't name stocks, Vikas, but give us, a little more of a sense, a slightly deeper sense. I mean, for instance, you said premium consumption, but a lot of these stocks have also run up, whether it's hotel stocks, whether it is something like, real estate. Which way would you play premium consumption now? Through which micro segment?
You have to, and you're right in that sense. The interesting thing is that wherever, so see, in consumption space, what's happening is consumption patterns are changing. or consumer consuming earlier may not be consuming. So new age consumer consuming different, and they are kind of basically they're consuming more, new and better, and that's how it happens. But those shifts are there. And one thing is very clear that premiumization is happening in every category. So those benefits, so wherever companies are aligned in this, you have to look at this. Now, hotels, of course, is a very big segment. The entire hotel capacity of India is less than Dubai. So it's a huge scope. But the point is that, it has its own, sort of valuation. I mean, it's own, like you have to put a capex, which takes time. And by the time, so a lot of companies are going into a capex phase. And, to that extent, I think, and valuations are like very demanding. So you got to be careful. Very often, just because something is looking promising does not mean that it will, make money, or you have a money making opportunity based on the risk reward. Because as an investor, we have to see risk reward of investing is there or not. Very often fads do come about, and, you get carried away by those fads and say that, so don't invest just based on like macro looks good, but you have to find micro risk reward also in the favor to make money.
In the past, you've spoken about infrastructure plays, I think, in railway and airports. So airports, of course, there are limited ways to play it. You only have, say, an Interglobe Aviation. But on railways, can you provide some more color on how you're playing it?
I think so. We don't have, I think in railway, there's a lot of, in my opinion, fad and valuations are kind of on the other side. And, so more than that, I think I'll probably comment on your infrastructure comment or question that I think there's an interesting play where we can find deep value and or a very interesting value is in the EPC players, the pure play EPC players where, margin profile is very good and the working capital cycle has got, compressed because today execution has become very, very important, whether it is public contract or private contract. If I am doing a construction of a building or construction of road or construction of metro, the timeliness of thing has become very important. Hence, the working capital cycle has become important. Order book of all the companies are very large. Now, a repaired or better business model and available at 10, 12, 15 time price to earning versus all other players which we talked about, which are like so structurally investment cycle is on uptick. The executor or doers of those those investment cycle are right now available at a reasonably good valuation. That's a one sub segment. I do believe that the risk reward is hugely in favor.
Okay, that's interesting. Yeah, EPC players, and we haven't seen the market to talk about them, and they've almost become forgotten. Pure EPC contractors. Got that point?
And here, one thing which, in my opinion, markets have missed is the repair on the working capital cycle. Historically, I think this sector has been struggling with the working capital because payments get delayed. But today, be it a private or public sector, everybody wants to get execution done faster. And because of that, the payments don't get delayed, generally speaking. I'm not talking about for everybody, but generally speaking. Hence, your working capital cycle is better. Hence, your cash flow generation also has become better.
Okay, all right. That's a very interesting perspective. Because before we let you go in manufacturing, and we always discuss this with you, it's a very wide, array. Everything can be clubbed under manufacturing. So you need to know what to pick and where to go. So give us some more nuggets. I mean, perhaps it's CDMO, that's what you're looking at. But within manufacturing, for instance, would you look at power, something else, auto ancillaries?
I tell you, I think broadly, you rightly said, it's broadly spread between auto components, chemicals, textiles, garments, power, capital goods, defense, electronics, multiple, right? But I think right now we find a lot of risk reward, especially in the chemicals where most people are negative around it. Structurally, chemical is a very good play. And most people have kind of, don't own it, and some companies have struggled. But we think the inventory cycles have cleared, bad cycle is behind. In risk reward is falling into place. That looks reasonably good, but differentiate between commodity and specialty chemical. That's where most of the fault, the mistakes gets made. And secondly, I think we think that even some of the auto component companies are also, again, I'm making a general statement, but you've got to look at company specific. They are also interesting. Risk reward is falling into place for many companies. These are two sub-segments. We have recently found some values and some ideas.
Okay, all right. Good clues there, I think, for our viewers to then go ahead and do their own homework. Thank you very much for joining in. Nice conversation as always. You have a good rest of the day. That's a view from Carnelian Asset Management, Vikas Khemani, with his thoughts on the market. Let's take a quick break on that note. We'll come back on the other side and we'll, of course, have final trading ideas coming up with Mitesh Thakkar, and then we'll focus on some more stocks.